Hello, this is Loeys, global strategist, JP Morgan, on December the 17th. Well, clearly nearing the end of the year. What are we going to do next year? Well, this year actually was quite turbulent. You add it all up, the markets actually did pretty much as we had hoped. The overall strategy worked. For next year, I think we're still in economic recovery. The world growth just around 3.5%, not that dissimilar to this past year. But given that we should be approaching the third year of the recovery, confidence in it should be improving, which means that there's a higher risk probability that corporates will be becoming more confident in it. As a result, we see decent upside risk on our growth forecast. Market drivers for next year, I can think of 4 major themes. So one of them is that just as the recovery gains, we're getting further into it. At some point, we need to see a significant adjustment in monetary policy, both in developed markets and in emerging markets. I think investors are going to guess that central banks are willing to be a bit behind the curve. So as a result, there'll be very strong demand for inflation hedging. Not that inflation will do much, but there will be worries about the future. As a result, good demand for commodities, inflation linkers, real estate, and the like. Second theme is still worsening quality of the public sector's balance sheets. They're not going to get better very soon. Even in 2-3 years from now, we see debt to GDP in developed world still rising. Implication of that is that investors will want to steer away from the public sector, everything having to do with it, and prefer corporate securities, both debt and equities. And the banks, where do they fit? Well, they're going to have to convince the market that they belong to the corporate side rather than to the public sector. That's going to be the challenge. Third theme is going to be emerging markets. Emerging markets pass the test enormously well. They're now considered the new safe haven. Everything seems to be going perfectly. All the money is moving there. Can we really say that nothing will go wrong? We have to be careful over here, be on the lookout, mostly for policy mistakes. Some central banks will take too much inflation risk, so watch out when they lag behind. We remain somewhat overweight emerging markets, but are careful here. The result, clear preference for equities over fixed income in emerging markets. And then the equity market, the hated asset class of the last 10 years, as equities did not perform as hoped. As a result, most of us moved to fixed income. We pushed real yields down to almost zero. And now we have to recognize that very low yields on bonds are not the solution either to our pension fund problems. And I think investors are starting to notice, particularly as the quality of government debt is not what it used to be. And as a result, I sense the beginning of a move back into equities as the mainstay of your retirement funds. So returns, asset allocations, we think solid double digits on equities, 20% more. Commodities about 15%, given supply constraints. High yield around 10%. The rest of the fixed income market nicely lining up in the mid-single digits. Asset allocations, clear overweight equities versus bonds. And within that, the main trades we have are overweight small caps. We're overweight high yield market, CMBS market, small overweight emerging markets. Within bonds, the preference for, let's say, core Europe and the US, underweight UK, underweight European periphery. Commodities, we're overall long, and we like in particular agriculture. So overall, quite confident and bullish for assets, asset classes into next year. With that, I'd like to add my wishes for a good, strong next year. Thank you.